Understanding Loan Amortization, a comprehensive guide. Loan amortization is a crucial aspect of personal and business finance that delineates how borrowers pay off their debts over time. It involves the gradual reduction of loan balances through structured payment schedules. In this article, we will break down the components of loan amortization, explore its significance, and illustrate its application with a practical example. What is amortization? Amortization refers to the process of gradually repaying a loan through regular payments. Each payment consists of both principal and interest components. The primary goal of amortization is to ensure that by the end of the loan term, the balance has been completely paid off. Key components of amortization. An amortization schedule typically includes the following columns. 1. Period. This represents the timing for each loan payment. Though often monthly, it can also be bi-weekly or quarterly. Each row in the schedule represents a payment which can be indicated by payment numbers, e.g., Payment 1, or specific dates, e.g., January 1, 2023. 2. Beginning loan balance. This is the amount owed at the start of each period. It can be the original loan amount or the previous month's ending balance. 3. Payment, the total amount due for each period. This is often a fixed amount over the loan term, allowing borrowers to budget easily. 4. Interest, this portion is the cost of borrowing and is calculated using the beginning loan balance multiplied by the monthly interest rate, annual rate divided by 12. 5. Principal, the remainder of the payment after interest is deducted. This indicates the amount applied to reduce the outstanding balance. 6. Ending loan balance, this represents the remaining debt after the principal is deducted from the beginning balance. Structure of loan payments. Payments are structured in such a way that early on, a larger portion is allocated to interest rather than principal. This means that in the case of long-term loans such as mortgages, significant equity is not built in the initial years. While this benefits the lender, it can be challenging for borrowers wishing to sell their homes. Benefits and drawbacks of amortized loans. Pros. Predictable payments. The steady monthly payment amounts allow individuals and businesses to budget effectively over time. Reduction of balance. Each payment incrementally decreases the loan balance, leading to eventual full repayment. Cons. Slow principal reduction. In the initial phases, a large proportion of payments goes toward interest rather than reducing the principal, which can make selling a property challenging. Amortization of intangible assets. While amortization is commonly discussed in the context of loans, it also applies to intangible assets in business. This involves writing off the expense of intangible assets, like trademarks or patents, over their useful lives. Relevant differences. Depreciation. For tangible assets like machinery or buildings, the term depreciation is used, which follows different accounting principles compared to amortization. Tax implications. The Internal Revenue Service, IRS, allows for certain deductions for amortized assets, enhancing business profitability and tax strategy. Importance of amortization. Amortization provides clarity in financial planning for both individuals and businesses. It enables them to understand their cost structures, forecast future expenses, and prepare for upcoming cash flows. For businesses, amortizing intangible assets can significantly impact tax reporting and liability, offering more accurate insights into performance and valuation. Amortization versus depreciation. Both terms relate to cost allocation, but they apply to different asset types. Amortization is for intangible assets. Depreciation applies to tangible assets. Example of amortization. Let's consider a practical example using a 4-year, $30,000 auto loan with an interest rate of 3%. The monthly payment is calculated to be $664.03. First payment breakdown. Interest payment, $30,000 times 3%/12 equals $75. Principal payment, $664.03 to $75 equals $589.03. As payments continue, the interest portion decreases while the principal component increases, illustrating the evolving nature of amortization. Conclusion. Loan amortization is an essential financial concept that affects a borrower's repayment strategy and understanding of their debts. By comprehending how payments are structured and the implications of amortization, both in loans and for intangible assets, borrowers and business owners can make informed financial decisions that foster sustainable financial health. Understanding the intricacies of amortization can help mitigate potential pitfalls during the course of financing and asset management.